Hello friends, in my video last week, I warned you that the bulls were likely to encounter some challenges on the way up and how prescient and how predictive that video turned out to be. I'll let you be the judge of that. This video is about exploring whether the Indian markets, which have been outperforming their global peers so far, and that too spectacularly, will they continue to outperform the global markets? And if yes, what will cause that? And if no, what will cause the underperformance? I use statistical data to basically put forth my arguments, and I want to put you ahead of the crowds in my videos. So let's dive right in. Coming up on your screen is the market roundup window. You can see that the NSE Nifty 50 lost 1.12%, whereas the Bank Nifty was flat. Gold and silver fell because the US dollar index gained 73 basis points. Natural gas was flat, but crude oil rose up. Now that is a minor red flag. The Indian 10-year benchmark bond yields fell 0.04, where bond prices went up, which cushioned the Bank Nifty's decline. MWPL fell, which is very routine on an expiry during an expiry week, and it starts picking up to the third week of the derivative cycle. The biggest red flag that I see was the slam dunk decline in the US markets, particularly what I saw on Friday night and early morning, early hours of Saturday, tells me that the opening levels of the Indian markets on Monday are going to be nervous at best. On your screen right now is the daily chart of the US Dow Jones Industrial Average. You can see what a huge decline it was on Friday, and the big 1,000+ point red candle tells you that. The 33,272 level has been breached, and the death cross, which is the 50-day average being below the 200-day average, is still in place. We are now heading towards the second support of 31,886. Should that be violated, I think the bulls in the US markets will be on the back foot. Let's see what the Nasdaq 100 index is doing. Similar death cross is still in place. 12,898 previous swing high, which was acting as a support, stands violated thanks to the big slam dunk decline on Friday. Price is below its 50-day moving average and heading towards the support line of a bullish triangle. So no easy day for Indian technology stocks because the Nasdaq impacts tech stocks in India. S&P 500 has fallen below the 4178 levels, which was the previous swing high resistance. It's closed below the 50-day moving average. The death cross remains in place. So the broadest based index of all three indices discussed is also feeling the heat. So global cues, especially coming in from America, are likely to weigh on domestic markets. No easy day there. Coming back to our local markets, what we are seeing is MWPL, market-wide position limits, have fallen to 22.09 on Friday, which is the first Friday after the expiry of the August series. Every 4 weeks, you see the MWPL level plunge, which is normal. But what we are seeing is July series saw a bottom of 21.48, which was higher than the June series at 1975, and August is 2209. So very typically, risk appetite from two marshmallow traders is higher. They've taken higher exposure, which is what is likely to trigger higher volatility. As I have pointed out in my live mint column, my weekly live mint column, which is India's first and only column in the news media, which uses statistical analysis for its readers. Do connect with me on social media, especially my Telegram channel. I put up links to all my work there, and you can stay ahead of the crowds by availing of these ideas. Now, the MWPL rising is both good news and bad. Why bad? Good news is risk appetite is up, but why bad? As I mentioned in my live mint column, the terminology of accounting called LIFO, last in, first out, applies to stock trading as well. The latest positions added by the bulls will be the first to get sacrificed if the market decides to dive. You won't surrender your previously held positions which are in profit. The ones that are recent and have started to turn negative or loss making are ones that you will sacrifice first. And since the highest amount of exposure addition has come recently, those positions will get chopped, leading to higher statistical beta or volatility, which is why I requested my viewers to cut down their trading exposure in the week, because I expected volatility to go up. Did it go up or not? You are the best judge. The turnover chart. What you are seeing is the turnover has come down sharply on week basis, which is pretty normal considering the fact that the markets have been either range bound or nervous at best, which leaves the trader completely paralyzed, many a times cutting back on exposure, and especially if you're losing money, you might even freeze up. So turnover is down, and I have recorded a video as to why falling turnover in a falling market need not necessarily be a good thing. The hyperlink to that video is in the description and the pinned comment below this video. The basis chart. Basis is nothing but the future premium or discount prevalent at that point in time. And the basis chart of the Nifty and Bank Nifty are showing period highs, 20-week highs respectively. Why is that? Because the rally in India, which has been against the backdrop of a weakness in the overseas market, making India a relative outperformer, has surprised many bears, and they were forced to cover their shorts. And short covering has taken the Bank Nifty basis to 235 points almost, and Nifty basis to almost 95 points. The one thing that I noticed, which was very typical and something that veteran traders will instantly identify with, calendar spread traders were forced to cover their shorts even in the mid-month series. Not only is short covering prevalent in the first month, but it's also reaching the mid-month. That tells you that the premium, which is so high, is unlikely to sustain, because once the shorts are squeezed, the premium will come down. Now for the advanced decline ratio after the price, this indicator is the most leading indicator of which way the winds are blowing. And the advanced decline ratio climbed back above 1 after hitting 0.52 in the week prior. Now that we are up above 1, we need to monitor whether in the coming week the bulls are managing to dominate the bears by keeping this ratio above 1. If they do, then the Indian markets have the chance of continuing to outperform global markets. By outperformance, what do I mean? I mean they fall less than the global markets when the overall markets are falling, and they rise more than the global markets when global markets are rising. Even if the Indian markets don't fall and they remain flat while global markets are falling, that would be relative outperformance. So the advanced decline ratio is something that will tell us whether we outperform or not. Now, my friends, the impetus chart indicator that you've learned to trust and bank on so much. Do remember that the week was flat. The Bank Nifty was completely flat. The Nifty 50 actually surrendered a little over 1%. No surprises there that the impetus fell. There was no force in the market at all. So any kind of an up move attempted by the indices was pretty half-hearted at best. The impetus is going towards the lower end of the 20-week range. That tells me that it's being coiled up like a ball pen spring. You can press it hard and keep it as long as you want, but when you get tired of keeping it compressed and you let go, the spring bounces. And if that happens while the market is falling, if the impetus bounces when the market is falling, you could get trapped into a bout of high volatility. So, which is why, my friends, you must trade light in the coming week again. Now, for the LWTD indicator, which has stood the test of time and has proved itself time and time again. Do remember that this indicator is up to Friday's closing in the Indian markets. It has not factored in the slam dunk decline exhibited by the US market. So, the Nifty percentage gain loss line has climbed up above 0 to 0.21. The LWTD indicator remains above 0 at 0.19 for the third week in a row. Like I mentioned, this is more of a postmortem because the US market element is not factored in. Do connect with me on social media. My contact coordinates come at the fag end of this video. I update this chart every evening for my viewers and my friends to stay ahead of the crowds. Now, friends, the footprints of the four types of market participants, starting with the FIIs, who on a week-on-week basis have surrendered their individual stock futures longs, and they have increased their short positions in the index futures. Where DIIs are concerned, they've continued to cover their shorts in the individual stock futures, and they've also cut their short positions in index futures on a week-on-week basis. Now, for the prop traders. Prop traders have basically enhanced their short positions in index futures on a week-on-week basis, but they've stepped up their individual stock futures longs by approximately 50% on a week-on-week basis. That tells me that these guys definitely seem to know something that the retail guys don't. Do remember, these are brokers' own proprietary trades. They know who's buying and selling just how much and at what price. If they are increasing their long positions in stocks, it's a well-considered decision. Of course, how this stacks up in the light of what happened on Friday night and Saturday morning in the US market will be seen in the coming days as well. Now, for the retail guys who've been doing all the very heavy lifting since the COVID-based lockdown started, they increased their net long positions in individual stock futures, but still remain below the 1 million mark. Where index futures are concerned, they've stepped up their long positions by almost 50% on a week-on-week basis. Net, institutional players seem to have unwound long positions, whereas retail and prop are actually adding longs. Now, friends, for the four heaviest weighted stocks and which way they can swing the market. Starts with the biggest boy of them all, Reliance Industries, with a weightage of 11.51% on the Nifty, beta of 1.11, which means if the index moves 1%, this stock will move 1.11% intraday basis. Unfortunately, the stock fell on 4 out of 5 trading sessions last week and has also been unable to cross its previous swing high and is precariously poised at the support level of 2618 levels. We want this level not to get violated and the stock continue to make higher highs so the Nifty can gain. HDFC Bank, the second heaviest weighted index stock in the Nifty and the heaviest index stock in the Bank Nifty. So what happens to this stock impacts both the Nifty and the Bank Nifty. Again, this stock, what you are seeing, has fallen on 3 out of 5 trading sessions, is still above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook remains positive. Also, the fact that the 1,421 level, which is a significant swing high, is still being defended by the bulls. So HDFC Bank still offers hope. Reliance is precariously poised in no man's land. The third stock, Infosys, with a weightage of 7.54% with a beta of 1.01, which is almost as same as the Nifty, has actually tanked. It's created a gap down while falling on Tuesday. And it has fallen on 4 out of 5 trading sessions last week. It is very critical that the gap that it left last week be bridged, be filled, and then the bigger gap, which is between 1,555 and 1,728, be also filled Do remember the Nasdaq 100 index has fallen sharply, which means the technology shares in India are also likely to feel the heat. So do watch Infosys in the coming days. Now, for the fourth heavily weighted counter in the Nifty, ICICI Bank with a weightage of 7.57% in the Nifty, and in the Bank Nifty, the second most heavily weighted counter after HDFC Bank, it enjoys a weightage of 23.72% in the Bank Nifty. Beta marginally higher than the Nifty at 1.03. This counter is by and far the strongest out of the four counters that we have seen. It stayed above the 867 levels on closing, even on a weekday like Thursday. Thursday saw a very late sell-off in our markets, but ICICI Bank evaded that sell-off, and the price still remains above a 25-day exponential moving average, which is a month-long holding on cost of a bull. So the short-term outlook remains positive for now. Friends, I now come to the bond markets, which are extremely critical for traders who are focusing on banking stocks, especially the Bank Nifty. Don't let anybody tell you otherwise, but bond yields are extremely critical even for equity traders. It's now resting at the 25-week exponential moving average. Whether the round number of 7% will be breached or not will be extremely crucial to watch out for. Do remember that I have been advocating you continue to ladder your bond investments because we just don't know where they'll peak out as yet, which is what I have been doing on a personal level. I've been laddering. I would want you to continue to ladder bond yields, especially the 10-year benchmark sovereign and the RBI Retail Direct portal, which allows you commission-free trading with banks without any broker, without any execution cost commissions and other levies, is 100% central government guaranteed bonds available there. So try to think away from fixed deposits where your insurance is only up to 5 lakh rupees per head. Bond yields falling tell me that bond prices have gone up a tad, which means banking stocks, especially the Bank Nifty, have received a little bit of buying support. If bond yields continue to fall, the banking sector, Bank Nifty especially, will receive cushion in case of declines. I'm not saying it will not fall. I'm saying it will get cushions. Now, my friends, I come to the US dollar index, extremely critical for all emerging markets, including India, because we are net importers. And everything that we import, especially fossil fuels, crude oil and natural gas, the landed price of these items depends on the currency peg. And if the dollar is strong, our landed price of imported goods is higher. It leads to imported inflation. So the US dollar index roared back. It gained on a week-on-week basis. It rose on 3 out of 5 trading sessions. The last day is particularly important for the simple reason that the Jackson Hole meeting of the US Fed announced continued interest rate hikes, and rate hikes are very bullish for the US dollar index because that will attract investments into the US homeland. Flight to safety, as it is known in international traders' parlance. So the US dollar index now is at a whiskers distance away from the previous swing high of 109.20. If it starts trading above 109.25 and stay above this, that could be some trouble for emerging markets. The price is above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook is positive. Coming to the weekly chart, we see a continued bullishness in the undertone. The bullish candle is, of course, smaller than the previous weekly candle, but nonetheless, we are at the threshold of crossing the previous swing high of 109.20 odd levels. And the price remains above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook is also positive for now. Friends, last week I advocated an expected range between 110.0 on the upside and 106.25 on the downside, which held perfectly well. In the coming week, I expect a range between 110.75 on the upside and 106.95 on the downside. Friends, the dollar index done, I now come to the Bank Nifty, which was flat on a week-on-week basis because it closed at almost the same levels as it did in the prior week. The Bank Nifty rose on 3 out of 5 trading sessions, as you can see on the daily chart on your screen. It closed above the 38,759 swing high, which was made in April. And the price is still above the 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook remains positive for now. The average itself is headed higher, which tells me that declines in the Indian market as compared to the overseas markets, especially in the Bank Nifty as we are noticing now, declines, if any, are corrections. They are not trend reversals. Do note the primary difference between the Dow Jones, the Nasdaq and the S&P 500 on one hand, the Bank Nifty's chart on the other hand. The Bank Nifty is coming down towards its rising moving average, and in those indices, the moving averages themselves witnessed a death cross. So will Indian markets continue to outperform the global markets? I'm betting that they will. I think we will outperform. Remember my criteria for outperformance: falling less than the overseas market, staying flat when the overseas markets are falling, or rising more than overseas markets rising. That's relative outperformance. So will we continue to relatively outperform? Yes, we will. It's a very emphatic yes. Now coming to the weekly chart, what we are seeing is that the Bank Nifty is showing signs of a very small bodied bullish candle, which you can actually see is the body is in the center of the weekly range, almost at the center of the weekly range. So there was indecision. There was a lot of tug of war between the bulls and bears, which is something that the impetus chart told you about. The price is far above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull, which tells you that the medium-term outlook is bullish. Like the last 2 weekends, I have been telling you, the further the price goes away from the moving average, the higher the probability of mean reversion. Prices get attracted to the moving average. So when the mean reversion comes in, that means there could be a corrective decline. I use the word correction, not a trend reversal, because Indian markets are expected to outperform the overseas markets. Friends, in the week before last, this index was number 4 on our in-house statistical beta list, the highest volatile counters list. The fact that a heavyweight index is high on the list tells you that it's fairly challenging to trade. Last week, it maintained its position at number 4 itself. So, which tells you that you must trade with caution. Last week, I advocated a range between 40,500 on the upside and 37,450 on the downside, which held perfectly well. In the coming week, I expect the range to be somewhat same. Do remember that this index has closed unchanged over the previous week. So the range is also more or less the same. 40,500 on the upside and 37,475 on the downside. Friends, the Bank Nifty done. I now come to the Nifty 50, which actually fell 1.12% on a week-on-week basis. And as you can see on the daily chart on your screen, it rose on 3 out of 5 trading sessions. But the declines were fairly prominent on those 2 days. The price is still below its falling trend line, which connects the tops made in October 2021 and thereafter. Whenever the price attempts to break out above a falling trend line or a previous resistance area, that attempt is always accompanied by a high degree of volatility and the prices thrashing about a lot. That is something that you experienced last week. Note what happened on Monday. Note what happened on Thursday. That kind of volatility is not something that every retail trader can handle, which is why last week I told you to trade light. Price remains above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. Short-term outlook remains positive. The 17,300 area will remain support to watch out for as long as the price remains above this level for most part of the week, and at least close above this for the entire part of the week. I think it's a small, healthy, required correction. We still remember are outperforming our global peers. The weekly chart of the Nifty shows a bearish candle expectedly because this index actually closed lower than the previous week compared to the Bank Nifty, which closed flat. And the week prior saw an inverted hammer, the green inverted hammer above the trend line. So we need now to close above that inverted hammer top to be able to rope in the doubting Thomases who are sitting on the fence waiting for a breakout. Once that breakout occurs, buying can resume again. Even a bear covering will basically pull the markets higher. The price remains far above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook remains positive. But like the Bank Nifty again, the distance between the price and the moving average is too great not to result in mean reversion, which means a healthy correction could be in the offing. In the week before last, this index was number 9 on our in-house statistical beta list, most volatile counters, and it maintained the position at number 9 itself, so no change. And last week, I advocated a range between 18,325 on the upside and 17,200 on the downside, which held perfectly well. In the coming week, I expect an anticipated range between 18,125 on the upside and 17,000 on the downside. Why the wide range? Because statistical beta is high, so prices can swing sharply in either direction. Time to trade light. Friends, the indices done. I now present you with the risk appetite of the retail trader by view of their footprint in the option and future space. The chart on your screen tells you that the light blue line is the percentage turnover of stock options, and the olive green line is the percentage turnover contributed by stock futures. What you are seeing is that both stock futures and options have contributed lower turnover on a week-on-week basis. Remember, this is a daily chart, so go back 6 dots and you see previous Friday's levels. It's lower. What does it mean? So if the turnover is lower in stock futures and stock options, where is the turnover coming from? The turnover is actually coming from index futures. Now, index futures means greater degree of safety, risk aversion. When risk aversion comes in, it tells you that risk appetite is lower. And therefore, in a correction, the bulls seem to be a little guarded. So we must also be a little guarded. Does it mean the end of a bull run? No, I'm not saying that. I'm saying that there could be some mild corrections. Friends, I now come to the most popular segment of this video for statistical systems traders who maintain statistical models like us. I give you 5 stocks that gained the highest amount of impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks which lost the most amount of impetus, so you take big exposure and wait for small price moves. This is for scalpers. Do remember, this list is valid only for Monday. If you wish to be updated for this list on Tuesday through Thursday, along with important pivot levels for the Nifty and Bank Nifty, do connect with us on our Telegram channel, where we put up a lot of goodies, a lot of good market-related, commonsensical, simple but highly accurate tools for our friends. And my contact coordinates come in the end of this video. Starting the hierarchy, the impetus gainers for Monday's trade. The list is led by RBL Bank at number 1, Emphasis number 2, TCS number 3, number 4, IDFC First Bank, number 5, Tata Communications. The impetus losers for Friday, which is a trading list for Monday, led by Ipca Laboratories, number 2, Torrent Pharma, number 3, Tata Chemicals, number 4, IGL, Indraprastha Gas, and number 5, Hindustan Aeronautics Limited. Friends, that brings me to the end of this video. And before I sign off, a humble reminder to click like on this video if you liked what you saw. Do tell us what you think about our work, and in the comment section, let me know what kind of experience you had with trading last week. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And please help us to reach smart investors and traders like yourselves by sharing my video with your family, friends, and social media groups to help us to reach a wider audience. I thank you for your patience, my friends, in sticking with me for this while in this video till we meet again in my next. This is VIjay Bhambwani signing off for now. I wish you have a very, very profitable and safe trading week. Thank you. Bye-bye.